Natural gas prices have just surged by 90% in less than 2 months. It has a history of making incredible moves, being one of the most volatile commodities that exists, sometimes moving up by over 600% within a single year, but also being able to lose as much as 80% of its value within that same time period. Natural gas, like other commodities, is prone to large supply and demand imbalances, and these can create huge opportunities for traders that are able to take advantage of them. U.S. natural gas futures recently bottomed at $1.60 in February and have already moved up by about 100% since. This move is similar to many of the recent aggressive recoveries we've seen on natural gas over the last decade, which often saw additional upside in natural gas prices over the months that followed. The big question is whether this move still has more fuel to run like it did in 2021, where natural gas prices continued to run by another 276% over the 12 months that followed, or whether this is going to be more like what happened in 2009, where this powerful natural gas rally proved only temporary and was followed by a devastating 68% move lower, completely decimating anyone who took on exposure to natural gas after the original bounce. To figure that out, we need to look at the supply and demand of natural gas, and we need to look at the price action to understand how traders can position themselves successfully while managing risk. Traders want to buy natural gas, or any commodity, when demand is outweighing supply, because this leads to higher prices. This is a chart that shows the total production of U.S. natural gas, and this line represents the consumption of U.S. natural gas. Now, we can immediately identify 3 key moments on this chart where production slowed down while consumption continued to rise or remain stable: between 2002 and 2006, between 2016 and 2017, and between 2020 and 2021. These happen to be 3 periods where natural gas prices rose for extended periods of time. These 3 periods represent some of the most spectacular moves we've seen over the last 2 decades on natural gas, ranging from a 200 to a 670% gain as a result of lower production levels. Today, U.S. natural gas production has stayed quite elevated over the last year. We can even say that production has outpaced consumption over the last couple of years. Now, this situation can of course change, but if they don't, the current supply and demand balance of natural gas isn't suggesting that natural gas prices are about to skyrocket. In fact, when we look at the storage levels of natural gas in the U.S., they're at quite elevated levels when compared to the average level you would expect at this time of year, as you can see from these lines here. For example, in May of 2022, the storage levels were quite low, which again doesn't suggest that there's any type of shortage of natural gas today, but that's just the story for the United States. Europe is the biggest importer of U.S. natural gas, so it's worth taking a look at their situation as well. This is what the storage level of natural gas in Europe looks like today. And when we compare that to the average storage levels that are typically seen at this time of year, we're in the upper end of that range. In 2021, for example, natural gas storage levels in Europe were much lower, clearly indicating an undersupply of natural gas that set the stage for the additional 400% move up in natural gas prices that occurred in 2021 and 2022. Now again, all of this could change very quickly, but the aggressive downtrend in natural gas prices that we've seen since 2022 can be explained by these high production and storage levels. If production begins to slow down, it could begin to get reflected in higher natural gas prices. That's why traders need to pay attention to and respect the price action. Natural gas managed to break above its 150 and 200-day moving averages. These are 2 key moving averages that acted as areas for the price to bounce several times during the uptrend in 2021. For the setup on natural gas to look more constructive, we need to see these 2 moving averages begin to slope upwards, just like they began to do in late 2020. These upward sloping moving averages are essential characteristics of an uptrend. Otherwise, there's a pretty big risk of getting whipsawed, like the breakout that occurred in late 2023. Traders that are looking for further confirmation that natural gas is indeed beginning an uptrend can also pay attention to this price channel. A breakout above this channel could indicate that the market is beginning to price in a future shortage of natural gas. On the other hand, traders that want to bet on natural gas moving lower, so shorting it, could take advantage of the fact that the price is currently at this price channel resistance. Initiating a short at resistance with a stop loss above the price channel could be a trade with lots of potential reward and limited risk that would take advantage of the high levels of natural gas production and storage in the US and Europe. Finally, it's important to consider the seasonality of natural gas. Depending on certain seasons of the year, natural gas will tend to perform better or worse. Typically, the best months for natural gas are August, September, and October, as the market often begins to price in rising natural gas demand before the winter begins. December, January, and February are just the opposite, where price begins to anticipate lower demand during the spring and summer. June and July are right in the middle, but are typically seasonally weaker months for natural gas. There's no better place for you to trade natural gas than Capital.com. The speed at which you can execute the trade is absolutely unmatched. This is a platform that was built by traders for traders, so don't miss a second to become a pro.